Hello, and welcome to Brain Booster, your go-to channel for all things related to personal finance and wealth management. Today, we'll be discussing one of the most popular investment vehicles out there, mutual funds. In this video, we'll talk about what mutual funds are, how they work, and how you can invest in them to make the most out of your money. Chapter number 1, what are mutual funds? First things first, let's start with the basics. So, what are mutual funds? At their core, mutual funds are investment vehicles that pool money from multiple investors to invest in a diverse range of securities such as stocks, bonds, and other financial instruments. The mutual fund then manages these investments on behalf of the investors who own shares of the fund. When you invest in a mutual fund, you essentially become a part owner of a diversified portfolio of stocks, bonds, or other assets. This diversification helps reduce the risk of investing in a single stock or bond and provides an opportunity for investors to benefit from the expertise of professional fund managers. Chapter number 2, types of mutual funds. There are many different types of mutual funds, each with its unique investment objective and strategy. Some of the most common types of mutual funds include: Number 1, equity funds. These funds invest in stocks and are suitable for investors looking for long-term capital appreciation. Number 2, bond funds. These funds invest in fixed income securities such as government bonds and corporate bonds and are suitable for investors looking for regular income. Number 3, balanced funds. These funds invest in both stocks and bonds and are suitable for investors looking for a balanced portfolio of stocks and bonds. Number 4, money market funds. These funds invest in short-term debt securities such as treasury bills and commercial paper and are suitable for investors looking for a safe and liquid investment option. Number 5, index funds. These funds track the performance of a specific market index such as the S&P 500 and are suitable for investors looking for a low-cost investment option. Chapter 3, how to invest in mutual funds. Now that you have a basic understanding of what mutual funds are and the different types of mutual funds available, let's talk about how you can invest in them. Number 1, choose a fund. The first step is to choose a mutual fund that meets your investment goals and objectives. You can do this by researching different mutual funds online, consulting with a financial advisor, or using a mutual fund screening tool. Number 2, open a brokerage account. To invest in mutual funds, you'll need to open a brokerage account with a brokerage firm that offers mutual fund investments. Most brokerage firms allow you to open an account online or in person. Number 3, fund your account. Once you've opened a brokerage account, you'll need to fund your account by transferring money from your bank account. Number 4, place your order. Next, you'll need to place an order to buy the mutual fund. You can do this online or over the phone. Number 5, monitor your investment. After you've invested in a mutual fund, it's essential to monitor your investment regularly to ensure it's performing as expected and to make any necessary adjustments. Chapter 4, tips for investing in mutual funds. Here are a few tips to keep in mind when investing in mutual funds. Tip number 1, choose funds with low fees. Mutual funds come with fees, such as management fees and expense ratios. These fees can eat into your returns, so it's essential to choose funds with low fees. Tip number 2, diversify your investments. It's crucial to diversify your investments by investing in a mix of mutual funds that have different investment objectives and strategies. Tip number 3, monitor your investments. As mentioned earlier, it's essential to monitor your investments regularly to ensure they are performing as expected. If a fund is consistently underperforming, it may be time to consider switching to a different fund. Tip number 4, understand the risks. Mutual funds, like any investment, come with risks. It's important to understand the risks associated with each fund you invest in and to make sure they align with your risk tolerance and investment goals. Tip number 5, don't try to time the market. Timing the market is difficult, even for experienced investors. Instead, focus on investing regularly over the long term to take advantage of the power of compounding. Chapter 5, advantages and disadvantages of mutual funds. Like any investment, mutual funds come with advantages and disadvantages. Let's take a look at some of the pros and cons of investing in mutual funds. Advantages of mutual funds. Advantage number 1: diversification. Mutual funds offer investors a diversified portfolio of stocks, bonds, or other assets, reducing the risk of investing in a single stock or bond. Advantage number 2: professional management. Mutual funds are managed by professional fund managers who have the expertise to make investment decisions on behalf of investors. Advantage number 3: liquidity. Mutual funds are generally liquid, meaning that investors can buy and sell their shares at any time. Advantage number 4: convenience. Mutual funds are easy to invest in, with low minimum investment requirements and the ability to invest regularly. Disadvantages of mutual funds. Disadvantage number 1: fees. Mutual funds come with fees, such as management fees and expense ratios, which can eat into your returns. Disadvantage number 2: limited control. When you invest in a mutual fund, you're entrusting your money to the fund manager, which means you have limited control over the investment decisions. Disadvantage number 3: market risks. Mutual funds are subject to market risks and can experience losses in a market downturn. Disadvantage number 4: tax implications. Mutual fund investments can have tax implications, such as capital gains taxes, which can reduce your overall returns. Conclusion. In conclusion, mutual funds are a popular investment vehicle that offers investors a diversified portfolio of stocks, bonds, or other assets managed by professional fund managers. Thank you for watching, and don't forget to subscribe to Brain Booster for more informative videos on personal finance and wealth management.